You're listening to the Multifamily Mentor Show.
My name is Terrence Doyle.
And I'm Chris Lopez. You probably know us from the BiggerPockets Real Estate Ride Along Show. Well, now we're talking everything multifamily. We bring in top industry experts from around the country to come join us in our Denver studio for an in-depth, in-person conversation.
We're going to be diving deep into deals, underwriting, raising capital, and everything in between. Join the conversation.
What's up, BiggerPockets family? We have a great episode today of the Multifamily Mentor Show. We have two great commercial mortgage brokers in the studio today. We're going to pick their brains and talk all about financing the commercial properties. But first, my co-host, Terrence, how are you today?
Chris, I'm doing super well. I'm healthy. I'm back from LA. My sister just got married, and I am excited to be here in the studio. I've only spent a couple hours with these guys, but I've learned a ton, and they're going to drop some golden nuggets on the audience about multifamily debt, about different ways to negotiate better terms and rate, and I think it's going to be an incredible show, so I'm excited.
And this is a show that we've been planning, and we've had some great guests on so far, but like, oh, what else do we need? Oh, we need lenders. We need a lender to come on here and talk to us about financing, because financing is often the most underappreciated, yet one of the most important parts of any transaction, and we're going to bring on our guests here. So we have William Foy and Marcus Davis with Spearhead Mortgage. How you guys?
We're great. We're excited to talk about financing.
Doing great. Thanks for having us, guys. Love your digs here.
Thank you. Yeah, this is a fun studio. Thank you guys for coming and joining us and having a drink or two while we do this. So first off, what is a commercial mortgage broker versus a commercial lender?
Yeah, great question. Thanks for asking. So we're brokers, and we act as intermediaries between the investment group, a buyer or an owner of a property, and the lending source, whether that be a bank or an agency or an insurance company or a private group. We're the middleman that helps the investors access the best debt for their strategy.
And, we actually got connected about a year and a half ago, right as the pandemic started, because we're all local here in Denver. We were helping a client do a deal, and we had a couple local banks we always went to that just, hey, talk these three banks, do the best terms, and go with them. And that worked out great with us until COVID hit, and the commercial market, just froze for like 2 months there. And we got in touch with you guys, and you guys saved us on a deal, and you've been the main brokers we've used for the vast majority of our deals here, because you guys are able to wheel and deal, which I think is a great thing with being a broker versus a lender, is you got some options on there. But you guys have an interesting background where you came from. So kind of talk about where you guys have come from and why you think being a mortgage broker is better than being a mortgage lender in terms of for investors.
Yeah, you want me to take that one? Okay. So Marcus and I grew up in commercial banking together back in the Wells Fargo days, and Marcus went on to Bank of the West and kind of recruited me over there, and then my whole team left Bank of the West and went to a local bank called Sunflower Bank here. Actually, we're based out of Salina now, and they moved their headquarters to Denver. But having that backdrop from underwriting deals with a specific credit policy and seeing all kinds of, ways that the banks look at things, it was pretty clear to us that we liked doing commercial real estate deals. And, lenders have a way of giving economic, conditions. They can shut off the valve on investor real estate pretty quick. And so we always felt like we would add more value to the market by utilizing multiple credit policies through multiple different lending platforms, be it like Marcus talked about, bank lending, life companies, debt funds, agency for multifamily specifically. All those things are things that maybe some investors aren't aware of or don't know how to access those. And so we can take their priorities to the market and give them a look from maybe one or two or even three of different platforms to get them the best option based on what their investment criteria are for a property.
All right. So you guys started out in, commercial banking for just, big banks. National banks and regional banks, right?
Correct.
Now, kind of for your careers, you guys have told me in the past you had an entrepreneurial itch to leave I don't traditional banking or corporate banking is the right word. I'm probably butchering that, but leaving that to being mortgage brokers so you guys can better serve your clients. Talk about the differences in those worlds of like, being a lender for a big bank and now being where you guys are, brokers and the middleman between the investor and having a great option of lenders.
Yeah, it's essentially night and day. When you were a corporate banker, that's not the wrong terminology. It's a stuffy environment where you're given one credit policy and you have to follow this credit policy. To William's point, this policy can change depending on economic times and different conditions. So for us, we found it being flexible as brokers, being able to communicate with over 100 different lenders at any given time. It allows us to be flexible for our clients. It allows us to be creative, which I think is most important. We're never going to try to force anybody in one product. It just doesn't benefit us. What benefits us is getting the client the terms that they need for their priorities. And then from there, hopefully we have a lifetime client. So I would say it's night and day because we can pick and choose which policies are most suited for the particular project and the particular goals, rather than just almost force feeding you a product that is the only one I can give you because it's the only one that fits.
All right. And so a lot of our listeners and viewers out there, they are active investors or investors with single family homes transitioning to multifamily or brand new investors on the investing stage. So give us from the very basics where we dive into some, more details and a couple of great examples of a 270 unit multifamily acquisition and a really interesting Fourplex portfolio that you refinanced into non-recourse debt, which are definitely more advanced credit strategies. But backing up some, what is commercial lending and how is it differ from residential lending?
Yeah, I think there's kind of really four main pillars that differentiate residential from commercial. And the first one of those that you'll want to know from a structure perspective is the loan to values. There's some crazy programs obviously on residential where, you can bring, single digit percentages in down payment. It's just not the case. Usually on commercial financing, max leverage is 80%, but, more than likely 70-75% type of loan to values on true commercial type of debt. The other difference you'll see is the term. Obviously residential 30-year fixed, pretty well known in the market. Not necessarily the case in commercial world. You're seeing 5, 7, 10-year fixed rates with 30-year amortization. So you do have a balloon in year 5, 7, or 10. And sometimes it's a good thing because it's sort of a dovetail into the next differentiator, which is prepayment penalties. You're probably not familiar with any prepayment penalties on the residential side. That's certainly a thing in the commercial world because in a lot of cases, these lenders are balance sheeting these loans. So they're not just originating and selling them off with the exception of agency world. That's exactly what they do. But those investors still expect to get a specific return on those loans that are put out there. So a lot of times you'll see a yield maintenance type of prepay, or with a bank, you'll see a step down prepayment penalty or something like that. So something to be aware of for sure as you take a look at your investment strategy and signing up for the longest, fixed rate term isn't necessarily a good thing if you plan to exit the asset before, the term of your loan is up. Origination fees is another, kind of a tough conversation we have with investors when they're, transitioning from residential to commercial. Banks are trying to make, some ends meet from a return on equity perspective from their internal guidelines, whatever it might be. They're usually trying to end up with some sort of return on equity. So when they're lending money out, if they're going to give you the lowest rate, they're usually looking to get some sort of origination fee on the front end, which is something you probably don't experience on the residential lending side. So those are kind of the main points I have.
One more going forward on that is just the whole thought of covenants, right? And ongoing monitoring of your asset and your investment. When you get your 30-year fixed loan on the residential side, it's usually just your walking papers. And as long as you make your payments, no one's going to really talk to you. On the commercial side, there's, annual covenants, quarterly covenants, depending on your arrangement. But really what they're looking for is that you haven't had any problems during that monitoring period. So
Problems like you could make your monthly payment. Rent rolls are about the same.
Yeah, you haven't a bunch of tenants leave. Those type of things. They haven't watched all your cash disappear. Things like that. They're monitoring you consistently going forward. And most commercial arrangements on the residential side, it's you get your loan and make your payment and you're good. So
It's a great point.
it's a big difference.
And I mean, you guys gave a lot of information there and details. And Terrence, this is something that you were talking about in between our live show and before it record on here was last year you were getting a refinance or HELOC on a primary residence, but you did a bunch of deals on commercial, and you had very strong emotions about both. Can you elaborate on that? Kind of give a
Yeah, in the middle of COVID, I think, especially when you're doing jumbo, my wife and I had moved into a different neighborhood. We have children. And, once you get over a certain dollar amount, I don't know what it is residential. I think it's like $589 or something. Now you're talking about a jumbo loan, and it was extremely difficult. I think every single family home I've either purchased or refinanced or done a HELOC on, there's been some kind of difficulty around the fact that I'm an entrepreneur and don't have a W-2. And so it's always stressful. I mean, stressful and difficult. And it's just like you're having to explain every single line item and where does money come from and how does it go out and how come your balance sheet is this, but your income is this, all these, questions that versus, when I'm buying a 200 unit apartment right now, and there's no questions about my personal financials. It's just tell me about the property, tell me about where the tenants are, why is there this vacancy, what are you going to do with rents, what's the construction, and so in my opinion, I think that if you do the right commercial loans, it's way easier. It's much easier than doing personal, home loans, just because it's not as strict of guidelines, right? Because they're not selling it to the public market. Like most residential loans are sold, they're portfolioing them inside the bank's personal, balance sheet. And so it's a much different underwriting process. And I think that's one of the reasons why I've enjoyed commercial real estate so much is it's much easier to get pre-approved and they more go on your track record. I can show them a list of 50 or 100 addresses. Hey, I bought this apartment for this. I put this into it. I sold it for this 2 years later. And there's not really a lot of strict underwriting on my personal balance sheet and income and expenses.
They're leaning on you specifically for the performance of that loan.
Exactly.
So
yeah, the guidelines and regulations, they all play into it. And ever since the last big downturn, it's become really hard to access residential financing. So you're not wrong about any of that.
Extremely strict. So I want to clarify something that I heard you guys say earlier, which was the points or the fees associated with commercial loans, right? Because that is one of the big differences. And sometimes these, I don't know what you guys are seeing, but sometimes when I've gotten different quotes, it can be in the hundreds of thousands of dollars in fees to close. And you had an interesting point, and you said that normally they want to make a spread and a return on their equity. So are you saying that if I were to come, on my next loan, if I say, let's say that for easy math, let's say that they were offering me a 3% interest rate, 5-year fixed, 30-year AM, right? And they were charging me 0.5% or something. Now, in a local bank. And if I said, look, I'll pay 3.25%, but don't charge me the origination. I'll drop the origination to $10,000. Are you saying that's how that they would look at it? Because in my mind, if I know I'm not going to hold the property that long, I can actually do some easy math and say, hey, this is where this is a win for me to lower the origination and raise the interest rate. Is it that easy of a horse trade? No?
I mean, yes and no. It's a right methodology. There's definitely a give and take in everything. If you want to ask for a little bit of love on your prepayment penalty, then you got to give up a little something here. I think a lot of institutions do need to see an upfront fee. Every once in a while, you can get a credit union to bite off on 0% interest, or a big national bank, or zero points origination fee, or a big national bank. But I think it's very common that you kind of just pencil in 50 to 150 basis points to get your deal going.
Okay.
And you almost budget that in every time you refinance as well. So that's where it plays into your priorities around what type of terms appropriate, because you're going to have a balloon regardless, right? It's just a matter of, does your balloon correlate essentially with your hold period, or does it just correlate with the longest amount that you could get? But either way, when that comes due, if you're not selling the property, you're going to get hit with those fees again. So that is definitely a big difference, because you're right. You walk into a residential mortgage shop and you might get a credit to refinance your loan, meaning they're going to pay you to do a refinance. You don't get that in the commercial world at all. And the due diligence costs that go along with that too. If you're changing institutions at the time of your maturity, you can expect to pay new due diligence costs around appraisal and sometimes phase one reports environmental. So those are all things to be thoughtful of when you're kind of comparing, a 5-year loan, I can get a 25 basis point spread difference in comparison to a 10-year note. But then at the end of the day, you're going to have to pay all those fees again in 5 years. So we just want to understand your priorities. And that's what we would challenge every investor to kind of look at too, is you're going to have these costs again. You're going to have them on a new project if you trade up. You're going to have them if you let this note mature. So the fees are coming at some level, and that's maybe the rougher part of the commercial world. But we all know that the profits are there too, and that's how you have to analyze these things. So
yeah, that's well said. So help me understand the different debt options for financing multifamily properties. This is the Multifamily Mentor Show. So we focus on everything, all things multifamily. This has been a segment that Chris and I have been really looking forward to. You guys are the first lenders we've had on. And so, we have everywhere from, or your first time investors buying a fourplex or an eightplex to, people that are trading out of fourplexes and eightplexes into 40 or 50 unit properties to more seasoned investors buying 200 plus unit projects around the country. So talk to us about and help educate, both of us on what are the different debt options and financing options for these different classes of multifamily properties.
Do you mind if I start with that? And then we'll just, let's just talk about like maybe your first type of investor first and then roll up to the most sophisticated.
Love it.
So yeah, if you're a first time investor, you're really looking at kind of like a local bank, a regional bank is consideration for your first project. Now, there's always going to be extra questions we have around, what's the most appropriate debt available for you. But if it's a heavy value add type of project, you can consider those type of banks. If it's an extremely heavy value add project and maybe your income is a little bit more challenging, you can really consider private financing as well. Both are going to offer you hopefully interest only terms on the front end that allow for you to kind of go through your typical lease up scenario, or just to get comfortable while you're owning your property to have some lighter payments on the front end. And to piggyback or to back up a little bit, I should say, 1 through 4 unit, we talked about the residential financing. There's lots of ways you can get that done. And some of that, the best way might be through a 30-year bare bones investor residential loan. But then if we're talking commercial, then yeah, we're going to start talking about banks, local banks, regional banks, and then kind of parlaying into private debt depending on how creative the structure is.
Can I pause you right here?
Yep.
Define local bank, regional bank, and private debt. So our listeners know what are those 3 definitions?
Your local bank's always going to be like a credit union, a bank that has its state's last name or the town's name in it is usually a local bank. A regional bank is someone who's going to support maybe that same market in the surrounding states. And then you get into the national banks, the big boys, which we're all familiar with, Citi, Wells, Chase, all those type of guys. But so I think going up from there, I think that kind of covers the
smaller,
the smaller investor, the first time investor, we could say. And then you get into some more creative options that are available through investors that, have a resume, I would say.
Yeah. So if you own existing multifamily, so true multifamily 5+ unit type of stuff, for a couple of years, you're eligible to access agency financing through Fannie and Freddie multifamily lenders and originators. And those are typically non-recourse structures where you're getting some interest only, longer, fixed rate terms. You're talking 10-year, they can get into 15-year and even 30-year fully amortizing type of structures. You're getting the best rates, obviously, on some of that 10-year fixed money with 30-year amortization, so 10-year balloon, if you will. But they are coming in with super low rates, and it is non-recourse.
And this is under. So let's talk 4 to 8 units, regional, local bank. And then once you get over, what is the sweet spot for an agency, and maybe define agency for us, but what is the sweet spot on that loan balance? Are you talking about a $3 million, $4 million loan balance?
So their minimums have sort of creeped up after COVID. They used to have small balance. Fannie Freddie used to be, $1 million. They could maybe trickle down into $750 and thereabouts. You're just not getting the good pricing at that point in time. So it sort of just naturally led into taking a look at banking options at those loan amounts. Now you get up to, I think their minimum now is right around 1.5 for a lot of originators there. And so 1.5 million loan amount, not acquisition price. I want to make that clear. The loan balance has to be 1.5 or higher. And that small balance goes up to about 6 million. Over 6 million is like a true Fannie Freddie type of loan.
Over 6 million. So you're talking like an $8.5-9 million purchase.
Correct.
Right.
Yep. Absolutely. Okay. And so those are non-recourse options. They are typically pretty low rates that follow the treasuries. And there is interest only available. The lowest rates there come with a yield maintenance type of prepay. So you better be ready to hold that asset through the term of the loan. Otherwise, you'll have a pretty hefty prepay.
What is the yield maintenance prepay?
Yeah, yield maintenance prepay is probably most easily described as you owe the full amount of interest through the period of the loan. So let's say you have a 10-year note, and this is adjusted for time value of money too. So it's a complex, algorithm, if you will. But basically, you have a 10-year note. You pay that off in year 5 by either refinancing or selling. You owe the interest due adjusted for time value of money for the remaining 5 years on your note. So that can be
That's
hundreds
a hefty
of thousands
prepayment.
And explain that to the listener, because I think this is fascinating, right? Because Fannie and Freddie, two agencies, are lending money on behalf of the federal government, right? Is that correct?
You're a government-sponsored entity, so they're given a budget every year to go lend and help promote, housing for people across the United States. To some degree, it is kind of government money out there, and the way these agencies work is they will have Fannie and Freddie originators who service the loan for the life of the loan. Okay, so you work with XYZ lender. That's who you make your payment to for the entirety life of your loan. But what happens on the back end is much like what happens on the residential side for 1 to 4. When a bank originates that thing, they're packaging it up with similar loans and collateral value and selling that off to the secondary market as investment vehicles. That's exactly what happens on the agency side too. They will originate this thing. They'll be your servicer. You make your payment to them, but they've packaged this up and sold it off to investors. And that's why the yield maintenance prepayment penalty exists, is because the investors who are buying that on the back end expect that return for 7, 10,
for whatever
15,
the fixed
20,
number is
years.
for 10 years.
Exactly.
And so when you pay it off early, they're still expecting those interest payments.
They're building in that revenue for that
they're going to get
specific reason. Yes, absolutely.
So talk about the horse trading or the negotiation that goes on. I bring you a deal. It's a $10 million deal. And, there's all these different options out there. So when is it the right situation to go with the yield maintenance and the prepay versus something straightforward that doesn't have that? Walk us through the different, if you're educating someone on what the right loan is for them.
I'll preface my answer to that by saying there are step down type of prepayments available in the agencies. It just builds a spread into your rate.
Mm-hmm.
Okay, so
you're going to pay more.
Yep.
Yeah, because they're still expecting that
give
return.
and take we were talking about.
Exactly. So we want to just be 100% sure of your hold, right? So if you think it's a 5-year hold, we'll put you in a 5-year type of Fannie Freddie scenario, unless you have a prepayment penalty of like a 31000 is available on a 5-year term.
Which means 3% if you were to sell it inside of year 2?
Sell it or refinance in year 1, 1% year 2, 0, 0, 0.
But 3% of the loan balance would be due.
Yep,
if you
exactly.
sold it for some reason. Well, okay.
Yep. They don't offer any prepayment penalties that get completely out from under the prepay on a 7 or 10-year option. So we want to make sure that either you're comfortable if someone knocks on your door and says, hey, I'm going to pay you an astronomical price for this property, you're cool with paying that prepayment penalty, or writing it into the contract so the buyer pays it. Okay. Or we're just talking about maybe moving to a step down, or maybe that's just not the right loan for you. If you think it's maybe a 5-year hold and you want 10-year type of financing, maybe that is more of like a national bank who can, burn off a prepay before that and maybe still offer some sort of limited guarantee instead. So those are all things that we want to understand are priorities on the front end.
One thing about agency financing that's unique in this market, at least, where everyone's getting a really hot interest rate in today's market, is these loans are assumable, meaning the fact that if I'm selling my property to you, you could assume my loan essentially. Now, does that cover your gap to buy your property? Probably not, but you'd still come up with some additional funds. But you might be able to take down our loan, which was done in good, favorable market times. And if this is 3 years from now and rates happen to go up, that's a good deal. You have a lot of deals right now in the market, deals that were done 4 or 5 years ago where the interest rates weren't as hot. But the only way these people can get out of their deal and sell their property is if someone was willing to come in and assume their loan, because they might have one of these yield maintenance type of scenarios. They just don't want to pay $1 million to get out of their deal. But if someone can come in and just take over their loan, and then as that loan matures, they can go and consider refinancing or whatever else. So,
and we're really into the weeds now because there are supplemental loans available too. So like, let's say you're going to buy a property, the seller wants you to assume their loans. They don't have a massive prepayment penalty. Well, obviously the value in that period of time for the property's gone up. They have like $3 million outstanding. You're buying the property for $9 million. You're not bringing $6 million to close the gap, right? So you can go back to that same agency originator and get a supplemental note and it's a first and second in that point in time
To bring it up to like 75% of total
there you go.
price.
Right. Exactly.
Yep, you're following along there.
What are the terms
your two
like
interest
on that
rates are
supplemental?
very different. Well,
It would align.
It's market.
Yeah.
Okay.
It would be probably a better rate in that
So
scenario
blended, we could
drew
get
up.
closer to what current market is today.
Sure.
Right? If it was 4.5 that I'm assuming,
And then you get
and then I get 3.5 now, and I'm closer to
Yeah.
4, and now
Yeah.
it's more digestible.
And that's a great way to look at it. And that's the way we would run the numbers and
Right.
kind of show
That's
that
the way
comparison.
you should run the pro forma for your
Yeah.
for your partnership. So that's really helpful. So that's on a 40 plus unit deal in like a major market where it's like a $9 or $10 million purchase. Those kind of, that makes a ton of sense. So
yeah, I'd say that we've done some really strange markets with the agency. We did a deal in Trinidad. That is not obviously a major market. You're getting the best pricing and best loan to values in terms of pushing leverage in major markets. Like Denver is a top tier market for Fannie and Freddie now. We've done deals in, outskirts Montana. We've done deals in Trinidad, Colorado. We've done deals in small, what they consider very small markets from an agency perspective. And all they do there is they just cap your LTV, and they'll make the debt service requirement higher. So it might not be 1.25
to offset the risk for being in a secondary market.
Exactly.
Now talk to me about the debt options. If I'm bringing you guys a $40 million deal, it's 300 units in Denver, LA, San Antonio, Austin, Tampa. Like what are you guys recommending? What are you guys seeing out there right now for that kind of acquisition?
Yeah, and that's solid because we kind of missed on maybe the last tranche of lenders available for large multifamily deals. And we would explore everything from HUD and FHA financing, where you can receive everything from 40-year fixed terms, which probably has the lowest interest rates in the market, all in, I would say, in today's.
But what do you need to qualify for that? Because aren't the barriers to entry on that pretty
They're extreme.
difficult? Extreme, right.
Agency in general is going to require some things like you always have to have sophisticated property management groups, right? They want to know that you have excess liquidity on your balance sheet. They want to know other experience metrics. They want to know that you're keeping your property up to a certain standard. So all things that would maybe parlay into why they're government subsidized programs, because they want to see you keep your collateral and run it with high quality. So on a deal like that, yeah, we would consider everything from FHA and HUD, which would allow for, like I said, some of the long-term fixed financing, very low interest rate. Insurance companies are a great fit for groups that are considering those type of purchases. They're always coming with non-recourse financing. Very competitive interest rates, typically not as long fixed term money nothing's as long as a HUD or a FHA type of deal. And then you have life companies as well. And life companies offer really good financing for top tier type of deals. They don't consider, $5 or $10 million deals in most situations, but they're looking for substantial size deals. And when you can get them, it's usually more short term money. But
what's like the minimum loan amount they would consider? 15, 20 million?
Yeah, 15, I'd say.
You can get a life company?
You can get a deal done lower, but they want to know you have more upside to your relationship, right?
And you said a top tier
groups.
deal. What does that mean? Is that like has to be class A or just better numbers? Like you have the market, then the deal. What do you mean by top tier deal?
Yeah, you kind of said it. Market, the performance of the property, the quality of the asset.
So they don't look at value add 200 unit deals.
Oh no, they
would
do. So the fun part is like HUD and FHA. They're a big promoter of green and taking like a C-class property and really getting it up to speed in today's world, and they support those with some of their loan programs. So that would be one that would maybe not be like a top tier qualification, but would ultimately get that type of financing.
Okay.
But yeah, I guess when I'm saying top tier, I'm really just saying you're going to get kind of the best deal in the market, right? For interest rate, term, whatever it is.
So what does that look like with a life company? Because I've never gotten a term sheet from a life company. What does that look like?
Yeah, absolutely. I think 5 to 10 year fixed money, usually 25-year amortization would be
So a little bit shorter than agency.
In most situations. There are definitely some life companies out there that would go out to 30. It's still non-recourse. Really, you're just going to look to see how does that compare against FHA? If we're doing a deal that size, we're bringing them all 3 of those type of term sheets. There's no way we're just going to one because they can kind of all accomplish the same thing. The HUD's the real unique factor with being able to go 35 and 40 years type of fixed financing. And that fits to a certain type of investor. Maybe not someone who's the life company. That's more like a private equity group who they're in and out of a deal.
Say the biggest differentiator there would be maybe leverage. Your life coach probably want to typically see anything from 65% or lower.
So
LTV.
pretty conservative.
Very conservative.
Right. And what would HUD do on that?
HUD will go up to 85%, sometimes 90%.
But what's the catch with that? The property has to be totally stabilized?
They have
There's a lot of catches.
They probably have 100 catches. Yeah.
There's a lot of catches.
Yeah.
There's a lot of due diligence that goes into those, which
so it just takes a long time
costs.
And expense to
Their
close.
typical close is 4 to 6 months.
4 to 6 months.
Experienced borrower for sure. Experienced operator, no doubt about it. You really got to be able to check all the boxes of an FHA deal, and you know what you're getting into. You have to really value the fact that you're never going to refinance this thing again.
You're talking rates in the 2s, like mid 2s for 30-year fixed or 35-year fixed, fully amortizing. In some cases, 40-year if it's construction.
So they're going to be.
So that's like the best loan available.
I would say
100%.
so.
But what's the prepayment on there like that? Is
It's a 10-year step down. So
okay.
it's 10, 9, 8, 7, 6, 5.
Still assumable.
Yep.
So you can work within those parameters too. So it's a fun loan. It seems to wear people out in a lot of times.
But when you get across the finish line, that's a huge deal.
You just won.
How many of those have you guys done?
A couple in the last 2 years, but they've been extreme work.
They've
They're a
been
grind.
every bit of 4 to 6 months and then some.
Yeah.
But 35-year fixed money in this environment
in the 2s
is insane.
2.5%.
Talk about a hedge
Definitely worth
against
it.
inflation.
If you know,
right
I think the punchline
Right.
there is if you know you're going to hold a property, if it's really a legacy asset, the 6 months is well worth it.
Absolutely.
But if it's like a flip or something you're not really sure about, more speculative location.
They've been 2 families that we work with that are very hands-on type of investors. They really see the benefits in it. It's kind of our partner that we work with to facilitate these loans says this term sheet sells itself. If you don't get it, you just don't get it. You're not the right client for it. If you can't value the fact that you're going to get 35-year fixed financing and you're going to have to jump through some hoops and we're going to come out here and monitor this thing every year and whatnot, but it sells itself. So it's not one that you usually have to either get it or you don't.
Yeah, that's a marathon, not a sprint.
And so these are typically by investors just buying like a legacy asset. They're like, hey, I'm going to own this for
these have been refinances.
Decades and decades.
Yeah, these have been cash out refinances that we found good with. Acquisitions are tough just with the timeline, right? So if someone wants to acquire via FHA, we're going to piece it together through bridge financing first and know that the takeout's FHA. It's just going to be 6 to 9 months down the road.
And the construction is where it gets really interesting because they will underwrite and close on construction financing. And that's where you come into the 40-year fully amortizing fixed rate loans. And that's a fun program, but it's the same amount of due diligence. And, and then you go through a bunch of fire hoops for sure.
And then the other last one there is just some national groups have real estate teams that can get involved with big ticket sizes like that. That would be kind of how we would explore the whole entire market.
What do you mean by national groups? What's an example?
National banks like the Wells Fargos and Chases of the world. If
they would get involved in that and they get competitive in that space?
Absolutely. Yeah. If experiences, they have to check all those boxes at that point in time. They're really serious about the guarantors, even if they're willing to offer some sort of limited type of recourse, which is more of a challenge in this market. But that would be somebody else that could be a player, especially if non-recourse wasn't the main priority.
Yeah, I've never done a deal like a multifamily financing project with any one of the 5 big banks. I just think they're not even close. But your thought is once you get over 20 million, they become more major players in that space.
There's pockets within those lenders that are specific to multifamily or real estate.
Right.
And you've got to be able to get it. You're not walking into your branch and finding that. So,
exactly.
Yeah.
All right, cool. So, my background's in sports. So one of the things I like to focus on is fundamentals. I think the fundamentals are what really make people the best at what they do. So walk me through what are the fundamentals. If someone is going to buy a deal, what are the things that they need to have prepared in order for you guys to get it? You guys are brokers, right? So you guys are 100% commission. So you guys have to pick and choose who you're going to work with and who you spend time sourcing debt for, right? Just like brokers that are going to go find properties for investors, right? They have to pick and choose who they're going to work with. So walk me through what are the boxes that someone needs to check in order for you guys to get excited and really spend time and invest your company hours into helping them find the right debt.
I guess first things first is being able to tell your story through experience. Do you have investor experience? Are we talking about kind of one of these residential loans or a commercial loan? Or are we talking about maturing you from a residential loan into a commercial property? So I guess we'd want to understand their experience first and foremost. And then from there, we'd start digging into the financials on the individuals involved with the deal. So that's when we're going to start to explore, personal financial statement, your tax returns, understanding your personal income, your own personal liabilities. So we can check those 2 boxes around experience and personal income and net worth. We would get into understanding the property, of course. Is the property stabilized? Is it a value add? Is there a pro forma associated with the deal? And kind of how do the historical financials look? And then lastly, we'd
you want to know your priorities.
Yeah, we want to know the priorities of the financing. Yeah.
Yeah. Tell us, you have an idea of what you're thinking. And I know that's property specific, but we also want you to be sort of property specific when you call us. So it's like, hey, I looked at this deal. I don't know if this is the right deal, but tell me, here's what I'm thinking. Here's what my financials look like. What would the financing look like? And we're always happy to have those conversations, loosely via phone and say, well, okay, give me some bullet points on you. Tell me what the property looks like, share the OM. We can dig into that and get to the bottom of that in a quick, 5 minutes, But we always want to understand your priorities so that we're not sourcing 10-year money with a prepay if you're only going to hold it for 5. Or if it's a buy and rehab and sell right after it's stabilized, we want to know that. There's, bridge financing out there for that, or even just pretty standard, 18-month bank type financing out there for that from a construction perspective. So we want to understand the priorities. We definitely take pride in understanding where you want to be with it so that we can source the appropriate debt. We don't want to just come with a shotgun approach and say, hey, here's everything that's available. It's an idea of what you're trying to do. It's your financial package. It's the property too, because in the commercial world, the property kind of more or less has to stand on its own unless there's a construction or rehab story to be told there.
Yeah, so I love that. So these are the 4 fundamentals for getting debt on any multifamily project, right? These are the 4 things that everyone needs to have before they call a debt broker, right? Or a lender. Anybody, because a lender is going to have even more than those, right? But before anyone gets financing for a project, you have to be able to share your experience. So either yours or your partners. You have to have some kind of a story that goes along with experience. You have to have your financials. So tax returns, personal financial statement, the property. Is it a value add play? Is it a cash flow play? Tell us about the property. Or if you don't have a property under contract, tell us what kind of property you're looking for, right? So we understand what the play is there. And then tell us your priorities. Are you going to hold it long-term, short-term? What are your priorities with the deal? Is that correct?
That's correct.
So those 4 things before anyone. So when people call you guys, if they have these 4 things, then you guys can check the boxes and get excited about going and finding them the right debt for their deal.
And cool. we like to pre-underwrite stuff. We're not just throwing stuff at the wall. I mean, we have good, solid relationships with our lenders, so we want to make sure that there's a deal there before we're kicking it to them. So that's part of our value add too. Is we're going to kind of try to poke holes in the deal a little bit on the front end and say, well, what do you think about this? What are you trying to accomplish here? And we'll have all that written up in our summary before we send it to our lenders. So that's part of our value add. If you're not good at kind of selling yourself to your lending relationships, we do that kind of for you.
Awesome. Now, we talked about the 5 C's, before we got on the show, and I love this. So walk us through the 5 C's that you guys look for in deals. From a lending, from a broker perspective.
Yeah, the 5 C's is kind of a generic rule in the industry on how deals are underwritten, right? Most conventional lenders are heavily regulated, and they have to be able to tell the story around these 5 C's essentially in their credit packet, so they don't get in trouble. Character is usually the first one that we're diving into, and that's who's buying the property, who are you, what does your character look like? That's analyzed through your FICO score, through other background checks, and through your experience. So ultimately, if we can tell a story that you haven't really burned anybody, your creditors, any personal relationships that would be worthy for business cause, then...
And that goes beyond just straight credit score and bank accounts and history. That's not just straight numbers. There can be some context and story there as well.
Absolutely.
Okay.
We've kind of both worked with people that just had a DUI that have had to explain themselves, or somebody got in a... It was just an alcohol story, huh? Someone's gotten in a fight at a bar or something, and they have to explain themselves, right? And that becomes really important if you're accessing some of these government programs. But character being one of the 5 C's, that's definitely important.
Sure. We touched on collateral a little bit. I mean, the property in commercial analysis should kind of stand on its own, like we said, unless there's some sort of value add or construction development play there, which case, the collateral as stabilized and completed makes all the difference. But, they're going to underwrite their property first, which is, we have a lot of calls from investors who are saying, well, hey, I want to buy multifamily. Here's what I look like. It's like, okay, well, do you have a property identified? And if not, we can't do a lot of legwork for you. We can kind of tell you as much as there is a pre-qual in the commercial world. Obviously it's a thing in the residential world, but in the commercial world, we can't really pre-qualify you because it's so property based. Is there cash flow existing on the property? Where is it located? What kind of pro forma is there to be done on this property? And so we try to do our best in that scenario, and we can kind of look at your personal financials and figure out whether you're qualified or not. But if the property is challenging, we've got to tell a more wholesome story there.
So investors can't expect to get a pre-qual or pre-approval from commercial lenders or brokers like we do in the residential world.
Not officially.
However, you guys can kind of like, hey, we can't look at the property, but hey, we've pulled your credit, we've talked to you, we looked at your personal financial statement. Hey, you look pretty good. It's more of like no major red flags. Is that my understanding on that?
I like to know, if I can get an understanding of the individual and then a subject property. Hey, if you can find something like kind, then we should be good to go. And I'm happy to put out a pre-qualification letter in that circumstance. If there's not a property behind it, we're just going to always kind of have that generic response where it's like, well, tell us the property and then we'll tell you more about it. Or just send us an NOI figure on top of what the debt amount you're looking for, and we can kind of back into it that way. But still, we're never able to tell the story of what's the address, what's the market, what's the, so there's always other questions.
Okay.
Another good one. Let's see here. Let's talk about capacity. Capacity is just your ability to perform on your current debts that you're responsible for and what you're asking for. So it's a combination of your personal balance sheet liability along with your income, and then the property's ability to help service that debt as well. So your just overall capacity. If you're overall leveraged as an individual, you're not helping yourself when you're applying for a loan. If you can kind of ease back on your personal liabilities, that's just helping the case, right? Both in residential or commercial financing or automobile financing, right?
Anything,
yeah.
Well,
that's
in
right.
residential, they're often, it's often between like 40 to 50% DTI, debt to income ratio.
Yeah.
You guys don't use DTI in the commercial
We
world,
really
right?
don't. There's a couple ways we can look at it. It's property specific, of course. How does the property perform on a debt service coverage ratio? And that's a whole nother conversation, but we can go there if we need to. And then the supporting income would usually be looked at as like a global income. Okay, so you have maybe your real estate schedule, which might have 8 or 9 properties on it, and then you have your own personal balance sheet that might have some additional debts on it as well. What does all that look like combined? And that would be your global cash flow. I think that.
Yeah, that's a big thing during COVID, especially is there outside income here? So that, in multifamily scenario where maybe it's 10 units and there's 2 units that are vacant, and the lender, quite frankly, is expecting higher vacancy throughout COVID, for obvious reasons. Does the individual have outside income that can help them, shore up the payment in tough times? So they looked for that. I think they're I wouldn't say they're backing off of that, but it's less of a highlight now than it was last year this time.
Puts another negotiation point. Like we were talking about earlier, if you got great global cash flow, you're just spinning off a ton of excess income, then that just helps you negotiate on a leverage position or to, knock down a prepayment language or whatever it may be. So it's good when the borrower knows their own kind of global cash flow look. Hey, I'm 5 times cash flow or whatever.
Yeah, capital kind of maybe be the next C, and that's, where's your down payment coming from? Is that on your balance sheet? Is it 1031? Are you raising money? Those are all things we want to know on the front end so that we can help tell the story to the lender as best we can. And leverage points, as we kind of already touched on, are, anywhere from up to 80% leverage, but it's going to be cash flow dependent on the property and what you're actually trying to accomplish there.
Okay.
Yeah, and the last one is just conditions, and I think, per the word, it's just like this is always changing, right? So working with a local broker should help you kind of understand the market conditions, everything from, local rents expected on that property to, what kind of, is there COVID going on? Is jobs down in that market? So there's so many different factors in that, but conditions are usually well identified in the appraisal, and the appraisal is usually leaned on for that.
And that's more property conditions, not borrower conditions.
Economic conditions as well.
Okay.
So that's that doesn't always get covered on the appraisal, but a lot of times it is reflected in it in a sense through market rents and whatnot.
All right. So cover the 5 C's here: character, capacity, collateral, capital, and conditions of the property in the market. So this is great stuff for people to keep in mind, just, that as they're getting everything for themselves organized, keep these 5 C's in mind. We want to pivot now to a couple deals you guys have done, because you've done some very interesting financing structures. I'll say very creative. And that's I think a great word to use with commercial lending is there's a lot more creative options on the commercial side than there is on the residential side, especially for conventional residential. That's check boxes in black and white. Commercial is creative. And we had talked about 2 deals you guys worked on recently. I want to start with this Fourplex. So it's a portfolio of 7 fourplexes that you help the family refinance into non-recourse debt. There's a 1 cent overview. William, kind of fill us on the backstory on there.
Yeah. So what's interesting about that one is that they actually are making this into an ongoing model with their builders. So they actually had contracted a builder to build these fourplexes and on kind of the same parcel of land. Each building is its own parcel, but look, the same lot look at it as a complex, right? There's a number of family members who had owned, in some capacity, the entire complex, if you will, and they'd done that by way of residential financing because they are 4-unit buildings. So the goal here was to, number one, take out some of that residential financing to free up opportunities to buy other single family, because they'd maxed out with
at the 10 loans.
Yep, at the 10 loan level. So they wanted some sort of non-recourse financing there to get those off and free up other investment opportunities. The other scenario, or the other priority, I should say, was cash out to go on to the next project. And sort of turned out that a priority was lowering the interest rate as well. So we were able to accomplish all of those things by kind of pooling that collateral and taking it into an agency loan. So if you have contiguous buildings that are, total 5+ units, that's eligible for Fannie and Freddie agency type of financing.
So say that again, the parcels must be next to each other and has to be 5+ units?
A little bit of I wouldn't say it's a gray area. There are guidelines around it. So they can do what they call linked loans, and Fannie and Freddie have different qualifications of what can be a linked loan. And that would be anything, that's within a quarter-mile radius of one of another.
Okay.
If that makes sense. In this scenario, they're just contiguous. They're looking at it as one complex being financed, even though the buildings, are separate parcels. So it's one loan, 7 buildings, 7 parcel numbers, just pooled collateral, if you will. So we're taking that to a 10-year fixed rate in the mid 3s, 30-year amortization, pretty low upfront costs, and it's non-recourse financing. And the family effectively just created a single asset entity that holds all of the properties together, and they all, instead of owning them individually, now own them as a percentage of a borrowing entity.
All right. So by doing this, they now are back below their 10 conventional loan limits. Go out there and buy more 30-year fixed stuff on 4 units or less.
Correct.
They are now taking no longer a personal guarantee. They've now moved it to non-recourse, and this is a whole, like a family unit. They got a better interest rate, and they were able to pull out some cash as well, right?
Yep. And they're going to roll that cash into the next very similar type of build structure. I think they got $1 million+ in cash out of this thing.
So that sounds like a great deal.
Yeah, it was a fun deal to work on for sure. We explored, I started working with one individual, and we started kind of applying some of these concepts, trying to get some of these single families off of his personal allocation, if you will, of single families. And we explored a few different options, and he ended up selling one. And then we talked about the agency financing piece, and he's like, well, shoot, maybe my whole family would be, interested in this and taking some cash out and lowering our interest rate. I think their payment ends up being effectively the same, even though they get $1.5 million or whatever it is in cash out. And so, yeah, end up being a great deal for the entirety family. And, we look forward to doing some ground up construction financing for them and permanent financing after that.
I like that. It's very creative, and that's a great win for the family.
Yeah, I wasn't aware that agency had that kind of program where if you're within a certain distance, you can pool smaller assets together to get to that small balance loan total that you need. That's incredible.
So if it's a true linked loan where they're a quarter mile or a half mile apart, I think Fannie's is a quarter mile and Freddie is a half mile or something like that. But if it's true, linked loan where you're combining two assets for one loan, there's a little bit of an uptick in the rate, something like a quarter point. But when it's all contiguous right next to each other, absolutely they can pull that into as one multifamily loan, not even a linked loan.
That's incredible.
And that's different than scattered site, right?
Yeah, scattered site for HUD. Yeah, it's very different.
Yeah.
HUD would be available on something like this as well, just maybe a smaller dollar amount for what HUD costs to get into it.
And the time it takes to get into a HUD deal.
That too. In a refi scenario, timeline's not usually a concern because their rates don't fluctuate with the treasuries like the Fannie Freddie options do. But we did have a conversation around that. It just, the fees were pretty heavy for the dollar amount that this shook out to be.
That's great. That's a great story. So let's transition to the multifamily acquisition in Tampa. So I love the operator story. So maybe give us a little background on that without mentioning names, and then we can go into the loan and how you guys got it done.
Yeah. We've worked with a legacy investor here. I would say in the Rocky Mountain region. He's done currently owns over more than 8,000 units himself, and just is really, I guess, would probably be studied at many business schools when it's all said and done on how to do it yourself and really build a massive portfolio. But this gentleman has historically accessed agency financing like many people would in his profile. And year over year, he's done, these community type of purchases. I would say 150 unit or more type of purchases where they're full service communities. And during COVID, just like a lot of people, they had to kind of go back to the drawing board to see what's what. The capital markets were shook. Agency had required everything from 12 months P&I reserves up to 18 months P&I reserves, depending on the type of term and program you were working with. That on a deal like this was going to end up being like $2 million just sitting on the sideline for this gentleman, and it just made zero sense for how he does business. So what we had done is we went back to the market. We explored some of the same players we had talked about before, where we went to our life company partners, our insurance company partners, and it was just still kind of coming off the back end of COVID, and they just weren't going to get to the leverage positions that he wanted to see. So we had actually I don't want to say convinced because he's much smarter than us, but we presented options to him that it kind of showed him the ability to get a limited recourse loan with no reserve requirements through a national bank partner of ours. And, the deal ended up penciling out into the twos, which is just fantastic. 10-year money, which is ridiculous. 4 years interest only to help support his lease up. And
30-year AM,
30-year AM, which
10-year fixed in the twos.
Yep.
And a partial guarantee?
Partial guarantee that will fall off after stabilization. There's a liquidity measure that most of us couldn't meet, but hey, it come with the creativity for this borrower specifically.
So did he have to actually put the money in their bank, or he just had to hold it?
It's just a liquidity covenant.
Yep.
So they just,
uncollateralized.
He just provides a statement. Yep.
Wow,
and that
cool.
meets that
every quarter or monthly?
I want to say it's quarterly.
Okay, cool.
Yeah. He'll be fine either way.
Yeah.
We're not worried about his. But that's a fun one where, I think if we caught, if that deal's getting placed in the next couple of months, that might be back towards the agencies, which maybe would have boxed us out, or maybe, we would have brought a different agency look to him too. And I think that's the other thing with working with a broker is, we can go to multiple servicers, it's not something we always do because hopefully we have a good idea as far as who's offering the best terms for the current market conditions. But if need be, we can let these guys kind of battle it out if needed. So
I'll say this too, about our national bank partner on this one. The agencies have ridden the treasuries up, and then kind of back down a little bit wherever they've gone. But they still haven't been able to get to the rate where our national bank is now, and they've held that pricing throughout. So that's kind of a fun
And they
story
did that through a swap hedge, where really and that would play into the prepayment risk for the borrower on a swap, where if interest rates go down, he's in a prepayment situation where he owes the bank some money if he did want to exit early. If interest rates go up, he's essentially in a position where he can make money from the bank. So it's a really unique hedge that most borrowers aren't even aware of, but it is available for deals, I would say bank deals above $5 million where you can.
And that lasts for the term of the fixed, or is it just for a certain portion of the 10 years?
It's the whole life of the loan.
The whole life.
Yep.
Okay.
But typically, the further you get with your loan balance being reduced, your risk.
The lower the risk is.
That's right. Regardless of what rates.
No, and you guys shared a great story about this gentleman that he's been doing this his whole life. He had a 4-unit that he owned in California and did a 1031 into 160 units in Colorado Springs.
That's right.
Which is like maybe the most incredible trade up I've ever heard of, 4 to 160. And he owns a big portion of his portfolio, almost free and clear, and nets over $1 million a month from his portfolio.
Yeah, that's
which
right.
is like
After
an insane.
Payments, yeah. It is insane. It's fun to review. It's fun to add value to a portfolio like that. It's fun to listen to this gentleman talk and just try to, pick nuggets like we're,
I think we need to have him on the Multifamily Mentor Show.
Wouldn't that be something?
Sounds like he needs to be a mentor of mine. That's incredible. I love that. So one of the two final questions that we typically have here on the show is, number one, if you guys want to each go through, what is your superpower? What would you say is the one thing that separates you each individually and as a company from everyone else?
Yeah, we talk about it all the time at our company, and maybe he knows where I'm going with this, and it's not scripted, but we just lead with values. We don't feel like we can control much in this world other than just our values and our effort. So I don't know if it's much of a superpower, but we just do what we say we're going to do, and usually that yields great results for our clients. But the market is changing, and sometimes stuff does happen and you have to be creative and come up with secondary and tertiary options. And that's what we take a lot of pride in doing, is just making sure we live up to our word.
Yeah. I mean, our mantra really is just doing right by people, and, if we end up getting burned by people for doing it the right way, hey, that's the way it goes. And we know we did right, so we will always have our borrowers, concerns at front of mind. And we do have kind of two clients. One is the borrower and one is our lender relationships. And the borrower seems to benefit from our lending relationships. So we always want to do things the right way on the front end. And that served us well to this point. We'll continue to work to operate that way. We are kind of a white glove service. We do pay attention to every single deal. We will handhold it from, the first conversation all the way through the deal being closed and booked, including like working with title and, doing those kinds of things. We don't just hand you off to a lender and say, good luck, hope it closes. I mean, we are part of the process until the very end.
And then one differentiator between like a boutique brokerage like ourselves and some of the national brokerages is that we just don't service debt for any of our lending partners, meaning that we have no, what's the
back end motivation to
Yeah,
steer
there
them
you
one
go.
way or another.
There you go.
We're giving them the brass tacks. Here's your options. Here's why we think this one's good and that one's not good. But tell us, here's what it is. And you can ask questions about it, and we'll give you some color on the lenders. And hopefully, those are very, open conversations about what you think is best for you and what we think might be best for you.
And that's just not always the case at other groups that do service, and we understand why they do. It's a great revenue opportunity, but it feels like we wouldn't be able to be as genuine if we did it that route. So there are some benefits in working with, I think, a boutique broker over a big shop broker.
Yeah, no hidden motivations. Everything's up front. You're just giving them, hey, this is what's best for you. There's nothing you guys are getting along the way that tilts the scale or where you guys are going to
exactly
lead
right.
somebody.
Better said.
And you guys are very focused on relationships too. Hey, bring value, understand what the investor wants, and say, great, here's your hold time. Here's what you want. Here's this. Hey, here's some great options, and think about XYZ as well.
And we hope that shows from our first conversation where it's like maybe you don't have a property identified and you just want to say, hey, here's what I'm thinking. What do you think? Or I've seen this OM. What would the structure be on that? We dig into that stuff for you, even if it's not a live deal. We are happy to have those conversations and tell you, hey, here's exactly how we think this thing would pencil out. And, we spend the time on the front end, to get to know you and understand where your priorities are.
All right. So last main question, I should say, for you guys is this is called the Multifamily Mentor Show. Terrence and I have some great mentors throughout our career and our lives. We have great mentors now. We're in a great position to start mentoring people ourselves as well. But along your guys' journey, and I'm going to start with you, Marcus, who's been a great mentor for you when it comes to just, investing and becoming a top-notch commercial broker?
Wow, great question. That's definitely caught me off guard. First guy that comes to mind is my last manager, Sean McGough. He'll love hearing this. No, just a guy that kind of taught me how to be able to give straight answers to people, to really understand credit policy and all the geeky stuff that you need to be a good lender. He kind of taught me all that stuff. And then along with that, just he's a high quality dude that I can look up to. And I know he's done a lot of things the right way. And that's admirable.
All right. William.
Yeah,
I see over there thinking hard.
I am thinking hard. I'm going to take a little different approach from the lender side. Actually, I mean, I have a good family friend of mine who has his hands in all kinds of different stuff, from oil and gas to like just branching out and just going to go build multifamily from the ground up and just in a market that's kind of strange. And we've provided a bunch of quotes for him, none of which they've penciled out to this point. But I mean, I hope to someday just be able to take a leap of faith and go build something somewhere and hold it. And it's been kind of a wild ride for those guys, but his connections and being able to raise money and take a stab at deals when you don't know the industry, I think that's admirable too, and it's something that I kind of aspire to be one day. So. Yeah, it's a lot of fun.
All right. And last following question from me is just how can people learn more about you two, and Spearhead Mortgage?
Yeah, I guess I'll take the lead on that one. Yes. Here's the quick plug. It's spearheadmortgage.com. It gives some recent transactions on there. We don't do just multifamily. We do office, industrial. We have a residential arm as well. We can do construction deals too, both, on any asset class, quite frankly. So you can go on there and look at some of the recently closed transactions, get a pretty good idea of, where things shake out. You're always welcome to call us. And I think our info is on the site. There's an info@ email on there, but it comes to our personal email. So we'll look at it. We'll call you, or just, give us a ring on the main line, and someone will talk to you and work through your priorities and give you an idea of where everything is in the market.
Perfect. Well, gentlemen, thank you for coming out. This is William and Marcus with Spearhead Capital. We've had the privilege of talking to you for the last hour about all things in commercial financing. As the audience can tell, you guys are in the weeds, you're in the details, and that's exactly what you want in a lender, someone that knows all these policies. I've got quite a few notes here from just nuances I learned in the last hour. I think Terrence did as well. So thank you guys. Really appreciate it.
Thank you guys.
Thank you for having us. It's been fun.
You're listening to the Multifamily Mentor Show.
Join the conversation.